Last week was an incredibly volatile week in the world of stocks. The VIX volatility index shot up to the high 30s on Monday, and CNN's greed and fear index indicated and still indicates quote unquote extreme fear. Now, interestingly, before the market opened last Monday, I believe very few people would have predicted that the market actually ends the week pretty much flat. I would argue that most people anticipated a very sharp sell-off in the US market as well.
Yeah, I'm calling for a 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut, and that's minimum.
Highlighting that predicting what is going to happen in the stock market over the short term is pretty much impossible. Nonetheless, I believe that the recent roller coaster ride of market volatility, economic uncertainty, and shifting trends has once again highlighted that we are currently navigating in an environment during which not all stocks are going to soar. It's not a market where you can simply throw a dart and hit a winner. No, I believe it's a market for stock pickers, those with the right instincts, sharp investment research processes, and those turning over a lot of rocks. So in today's video, I will explore why in the current landscape in particular, your success as an investor depends on being selective. And I will discuss three things. I will first of all discuss the yen carry trade. I will then discuss to what extent stocks are moving less in sync right now. And finally, I will look at the valuation of the S&P 500 and what it means for investors going forward. So without further ado, let's jump right into the video. Alright, hi there, my name is René Zellman and this channel is all about finding high quality stocks to invest in. And as explained, this video is going to be about why I believe the current investing landscape is a very attractive landscape for individual stock pickers. And the first aspect I want to discuss to highlight this thesis is what was happening in markets on Monday last week. So effectively what was referred to as the yen carry trade. I'm not going to get into the details of what was going on here. I will actually refer you to another YouTuber, The Plain Bagel, who did a great video on this particular subject. But the point that I'm trying to make here is that this was clearly a macro-driven event, a macro event that influenced stock prices pretty much all around the world. So the Japanese stock market indices dropped by, I think, around 12%, and the Nasdaq in the US also, if I remember correctly, opened negative around 4 to 5%. And obviously some of the constituents of the Nasdaq were down much more. Some were down more than 10%. And obviously, as an investor, this is something you should love to see. We have a macro event that for the most part is not going to influence the business operations of the businesses either in your portfolio or the businesses on your watch list. If you think of a company like Netflix, for example, how does the fact that the so-called yen carry trade is in the process of unwindling affect the operations? Well, it pretty much doesn't, right? So if Mr. Market gives you an opportunity to buy a stake in a particular business at a significantly cheaper price, due to a factor that is not influencing the business operations per se, this is what we like to see, right? And your job was just to be prepared, to have a watch list ready, which stocks you would like to buy at specific prices. And if one of these stocks was hitting these prices on Monday last week, well, congratulations, you probably found a long-term winner and were offered an attractive entry price. Now, the second aspect or the second chapter of this video that I want to focus on is the fact that stocks seem to be moving less in sync than they have done historically, which once again supports my claim that we are currently in a stock pickers market. So I want to start this chapter by actually bringing up one Warren Buffett quote. So one famous quote by the GOAT of value investing is that, quote unquote, only when the tide goes out do you discover who's been swimming naked. And the point that Buffett back then wanted to make with this quote is that obviously when we are in a favorable macro environment, most businesses will be making money. But when things turn south or get a little more difficult, a little more challenging, well, then you will really be able to distinguish between the really good business and the poor ones, and also the businesses that carry a ton of debt and those that are basically running a very healthy balance sheet. And basically, I would claim that we have been able to observe this phenomenon ever since the central banks all around the world decided to raise interest rates. So obviously, many of the COVID darlings got absolutely crushed over the last 2 years. And those businesses with actually proper business operations who run their businesses very profitable, they have actually done very well ever since, I guess, the bottom we hit in late 2022. And now I'm mainly focused on the tech names, of course. So again, just to clarify the point that I'm trying to make, I would argue that during the zero interest rate environment, the ZIRP environment, basically stocks all across the boards were growing in value. There was a quote-unquote rising tide that was lifting all boats across the board. And we are now entering or already into a territory where there is a bigger gap between the winners and losers. And during these times, it makes sense that the talented stock pickers will be able to add more value by being able to identify and invest in the winners and avoiding the significant losers. During a period where there is a bigger difference between the best performing stocks and the worst performing stocks, arguably there should be a larger percentage of active stock pickers that are able to actually outperform the market. Now, interestingly, if we actually look at the performance of active fund managers, so those who are picking individual stocks, we can see that the long-term trend continues, with most active fund managers actually underperforming the market. So I came across one statistic by Jason Zweig from the Wall Street Journal, who found that only 18% of actively managed funds that measured themselves against the S&P 500 actually outperformed the S&P in the first half of 2024. And I came across another chart by Morningstar that showed at the percentage of active fund managers able to beat the S&P over a 10-year time period. And as shown here, only around 27% of such funds were able to beat their benchmarks over the last 10 years. So I think what these numbers illustrate is that the asset management industry is more about marketing than actually delivering performance. But nonetheless, this doesn't mean that we are in a stock pickers market. Because at least kind of anecdotally speaking, or I guess that's my subjective impression, we definitely have a more significant gap between the very well performing stocks and the poorer performing stocks. And I believe that those developments, those performances are more driven by fundamental business factors nowadays than they were, for example, say in 2019, 20, 2021. And this brings me to my last point, my last chapter of this video. Let's look at the S&P 500's actual valuation right now and discuss what it means for returns going forward. So if we look at this chart here, for example, we can see that the trailing 12-month price to earnings ratio for the S&P 500 is around 25. And this valuation is above the 5-year average of around 23.5 times earnings and above the 10-year average of around 21.5 times earnings. And it's well above the long-term historical median. And what this means for investors was nicely summarized by an investor who I really look up to, John Huber, on X. He wrote, "Also, the 5 and 10-year averages are well above the longer-term average." This is what I just said. If the S&P 500 has the same earnings growth as in the last decade, but returns to a historically more normal price to earnings ratio, we would get a low single-digit result next decade. And let me just stop here real quick. So basically what he is saying is that if the multiple ever comes down of the S&P 500, this is going to be a major headwind for the returns delivered by this basket of stocks, pretty much regardless of what or at what rate the earnings will grow over the period you are looking at. So always keep that in mind, that the total return you can expect from stocks, individual stocks, but also baskets of stocks, is driven by multiple factors, and two of the major drivers are earnings growth and the development of the multiple. He then continues, "Good news is there are wide gaps between the large cap valuations and the median valuations for smaller stocks, many of which are very cheap. I'm more excited about that group relative to the market than I have been at any point since the early 2000s. And I think this is quite a statement that he's making here. Basically, he's saying that the opportunity set in the world of smaller companies is more attractive than it has ever been over the last 20 years. And obviously, as someone who is actively looking for individual stocks, this should be music to your ears. So to use an analogy here, just like you get a better picture of the condition of a car by actually looking under the hood and seeing the individual components of the car, you also get a better understanding of where the US stock market is at by looking at the individual components. Some components will be very richly priced, despite maybe a lackluster business performance, and others might be very cheaply priced, despite a spectacularly impressive business performance. And of course, those are the quote-unquote components you want to look out for. So just to back up what John Huber was saying with regard to small cap stocks, let me just show you two charts here real quick. So one is a comparison of the MSCI World, the performance of that index compared to the MSCI Small Cap Index. And you can see that the MSCI World definitely outperformed the index that is including smaller companies. And the same is true for the United States. If we compare the S&P 500, for example, to the Russell 2000, we also see a significant outperformance. I think that's an outperformance we haven't seen historically very often, if ever. And interestingly, quite recently, small caps have actually started to catch up, and arguably they still have a long way to go here, catching up to their larger counterparts. Now, I have two more thoughts on small caps here. First of all, I want to outline why looking at smaller companies is actually quite a compelling strategy for individual investors. So a couple of data points here. Historically, over the very long term, small caps have actually outperformed larger cap companies. Then secondly, as highlighted by John Huber and maybe also by the two charts that I was showing, although they were more focused on price performance and less so on fundamentals, but small cap companies are historically trading at pretty cheap multiples. Let me see if I can maybe find a chart after recording this video that I will then just overlay right now for you here. And then finally, one might make the claim that smaller companies are less efficiently priced because there is less analyst coverage for these types of businesses. Some of these businesses have no analyst coverage at all, which might lead to more inefficiencies in this, fishing pond, so to speak. And now I'm going to contradict myself here. I actually came across a tweet that I kind of can relate to. And this tweet said that, quote unquote, investing tip for beginners, start with investing in blue chip stocks. So those are the very big companies that are publicly traded. I think the definition is companies with a market cap above 100 billion US dollars. The definition sometimes vary depending on which source you look at. But so the super large companies. And meanwhile, to get back to the tweet, start learning fundamental analysis of stocks and then slowly diversify your investing strategy into mid-cap or small-cap stocks. And I agree with that sentiment because especially if you are starting out, I think the room for error in large-cap companies is smaller because overall those tend to be higher quality businesses if you look at them as a group. But then again, small-cap companies, there you might have a larger gap between the very good business and the very poor businesses. I think I came across a statistic the other day that X percentage of the companies in the Russell 2000 are actually not producing any profits. I'm not quite sure how high that percentage was, but I think it was something along 50%, which shows that these businesses on average tend to be of lower quality. However, if you are at one point able to identify the high quality businesses that have a massive runway ahead of them because they are so small, of course, this will present opportunities to investors that have clear and proven processes in place. And just to wrap it up here, if you want to develop a framework and have these processes in place yourself, I recommend you check out my mentoring program because in it you will get access to a ton of systems, checklists, spreadsheets, and so on and so forth. Really a ton of material that will help you to improve your investing processes. And with that being said, let's wrap it up here. Have a great day and see you in one of my next videos.